What's going on, everyone? This is Stephen Place with Precision Volume Alerts, and the markets are getting a little loose to the downside today. Nice little gap and go on a Monday. We're almost down 2% into the lunchtime trade, and it's feeling a little panicky out there. Now, if you've been reading the blog and getting our notifications, you will have seen an article that I wrote talking about how we tend to start seeing more volatility around options expiration cycles. And so just like we saw last month and the month before and the month before and the month before, it's a little loose. This one's a little different in terms of magnitude and speed and the kind of move that we're seeing. So it is a different flavor of it, but it does feel like there is a little bit of a bloodletting going on, which is fine and it's normal. We're supposed to see that in markets. Markets inhale, they exhale, people get too excited, and then they have to be punished for their excitement, and that's just the normal cycle in the market. Now, when we think about panic and we think about how that panic relates to the options market, most of the time people think about the VIX. The problem is the VIX is a much different animal after what we saw in 2020. Liquidity is down, so the VIX has stayed up. Instead, there is one extra panic indicator you absolutely have to watch if you are trading the markets, especially if you're trading options. So let's go ahead and hop over to our chart. So this is a chart of the S&P. We are down, what is that now? 1.82%. This is a 2.7 standard deviation move to the downside. So it's not something we see very often. It's a very strong move. A lot of people are getting stuck off sides. We had a lot of folks, including myself, a lot of hedges burnt off on Friday, right? That was September expiration. So I had some puts on, I had some put butterflies and some other advanced stuff, and they got wiped out, and those no longer benefit to the downside. So when you have enough traders under hedged, then this is the kind of move that you tend to get. Now, if we look at the VIX, and we're going to look at the spot VIX, not VIX futures, it's currently trading up at 25. But you have to look at how the VIX has traded since that spike in March 2020. The floor is no longer at 12 like it was before everything went straight down, right? Worst crash in market history. Our new floor is up around 16. Okay, and we've seen instances plenty of times where the VIX just stays up, and it's really not as useful of a panic indicator saying, oh, the VIX is up a ton. That means it's time to buy the blood. What we have seen over the past 18 months is a continued move, in my opinion, away from equity hedging and into volatility hedging. More and more institutions are using the VIX options, the VIX futures, those kinds of markets to express some kind of a hedge. So we can't look at the VIX. Remember, the VIX tracks the demand for S&P options. If we look at the VIVIX, this is a different animal. And this tracks the supply and demand for VIX options. And as you can tell, compared to 2019, the floor is right around 85 or so, and the new floor is around 105. Okay? And what we have seen over the past 9 months is we get a little bit of scary price action in the market, and then everyone floods into hedges basically all in the same 1 to 2 day period. And then if you get that instance where way too many people are hedged up, you can't see downside anymore because nobody has an initiative to sell. All right, so this is why we look at the VIVIX spikes, the spikes in VVIX. And what we can see here is that anytime we get, and it's kind of an eyeball, but right around 145. All right, any kind of move above 145 has been a buying opportunity in the markets. And it's not precise to the day or precise to the tick. Sometimes we have multiple days of selling, but that is a reasonable indicator to say, okay, it's time to start offloading some of our hedges, and it's time to get a little bit more aggressive with our long exposure. Okay, so that's what you have to be watching. You got to watch the VIVIX as it comes into the 140s, and it's a make or break kind of action, right? If we see a just rocket ship higher and everyone's panicking and there's way too much convexity, it will go higher than we think, but it is a volatility reading. It does not sustain at these levels for very long, right? If someone buys a hedge, they don't have to go and buy that hedge again. All right, so you have to watch the VIVIX, especially right now when the markets are getting loose to the downside and we're down 1.89% to the downside right now. Once this really starts to tick up, if it does, that's going to be the point in which there's a lot of bloodletting, there's a lot of puke on the trading floor when people are like, just offload everything we can in a very short term, and that's when you should start expecting a bounce and you want to start getting very aggressive. On the flip side, what tends to happen then is that you get traders selling way too many calls, and then you get this nasty short squeeze to the upside. And that's what we've just seen over the past 5 or 6 months with this market. So that's all I've got right now. If you want to see my exact trade setups and how I use my roadmap to find the most profit-rich opportunities, there is a webinar and training that you can go watch for free right now. Click the button below this video to get started with that, and I'll see you in the next video. Take care.